Thank you for joining us on Squawk. I'm Bruce Whitfield. You're watching CNBC Africa, first in business worldwide. David Jabera from Saspen, who spent some time in Grahamstown last week, broadening his artistic horizons, and Nick Norman-Smith from Lentus Asset Management are here to unravel this week's market news. And of course, the world dominated by the fear of Ben. Yeah, Ben Bernanke, of course, on Wednesday night, sat down after his latest meeting with the Federal Reserve chairman of the different Federal Reserve banks in the United States, and decided to not do very much other than hint that he might do something in future. What is this all about, David?
Well, I honestly tried to sit through the whole presentation, which was his speech and then followed by questions, and understand what he was getting at. The best that I can come with, and I've had to read summaries admittedly, is that by next year, June, if everything goes well, and you've got to keep saying if everything goes well, they will then stop their asset purchase program. 1 year later, if everything goes well, they'll start to raise interest rates. Okay, so you with me? They're going to
interest rates are not going up before the middle of 2015.
2015, exactly. But by 2014, this time next year, they will have stopped the asset purchase program completely. In other words, they're still at the 85 billion a month now, but they will taper it off, etc. So a lot of confusion, very difficult to understand and grasp what this all means.
But the bottom line here, Nick, is that they will continue if things go well. Now, what is the measurement of if things go well? How do we know if they're going to start tapering? Based on what fundamentals they're going to be looking at.
Yeah, it's going to be tough, and he certainly left it wide open. But I think what the positive from this is the world economy and the US economy is clearly in a state that they believe is strong enough that they can stop supporting it just as much. So the child's been riding around on his training wheels for a while, and we can start maybe thinking of taking them off. So that's got to be good news. I know markets are down because they're scared, because is this going to go out too soon and the markets are all going to fall in a heap because it was artificially stimulated, etc., etc. But the US housing market is turning around. The US consumer is not quite in such a poor state. The banks are cleaning themselves up. So this is what they wanted. We're getting there. We're making a step forward. So
I think it's one of the delicious ironies, isn't it? And you've said it before, David. As things are getting good enough to take away the support, the world panics that the support is being taken away. It's hold on a second. Nothing should change.
I think we've got to just work through it, because you're going to get traders readjusting their books accordingly. We're probably most vulnerable here in South Africa, together with a slower China, but we can talk about that later. But I think emerging markets are probably most vulnerable. I'm very positive on the US, and I'm very positive on the US for the next 2 or 3 years. Bernanke's gone. He's gone the end of January. Yeah. No doubt about this. He even won't be appearing at Jackson Hole. In one of the questions, he's got other engagements, and he brushed it aside, saying there's so many different Fed conferences. Now that's a sign that he's done his term, he's done what he's had to do.
He's done 2 terms,
2 terms, 8 years, but America is actually in the best shape of all the global markets, of all the big global markets.
Now, you've got then the people who say, well, see, Paul Krugman is right. The Krugmanites rule the world, because the only way to get out of trouble is to inflate your way out of trouble. And that's why America's on such a fine footing. Look at these idiots in Europe who've gone the austerity path. They're still in trouble. But nobody's looking 10 years hence. When we look back, as we look back on the history of Alan Greenspan, and we go, Greenspan, you ripped the ring out of it for far too long, you made money cheap. At the time, Greenspan was saving the world. Ben Bernanke has saved the world. Will we hate him for 10 years from now, Nick?
Well, who knows? But I think the good thing to look at is, I think he has to a certain extent, maybe you can argue he hasn't learned, but this is why we're talking about this tapering, because he wants to try and avoid it. Unfortunately, whenever governments intervene and people try and mess with markets, you do get it overshoots, it undershoots. There are clearly a lot of a lot of bubbles that are going to come out under the carpet that we possibly haven't even thought of yet. So yes, we'll get booms and busts. As investors, one needs to invest your money where you see the opportunities, because who wants to be a central banker? It's an impossible thing to do. It really, really is a tough job.
You're right, because what we haven't got out of is how he's going to unwind what he's bought. It's all very well he said that he's not going to be selling them, but somewhere down the line, he's got to start unwinding the trillions of assets that he has purchased, etc. Either allowing them to go through to redemption or managing that process. It's not going to be his problem. It's going to be his success.
But America's balance sheet is kind of lopsided right now, and that is of some concern.
The hope is that growth will alleviate a lot of the issues. Because if you do grow, If there is inflation, then it reduces the level of debt. And
if
so
you
on.
grow, and signs are that America will grow. I mean, signs are, and why is that then bad for us? Because here we sit on the southern tip of Africa,
Right.
things are getting back to normal. You mentioned that earlier. So things are getting back to normal. And we're, oh no, that's terrible.
You know why it's bad for us is that from 2008, cheap money that was available through these asset purchase programs and various other stimulus created what we call the carry trade.
Yeah.
What was a carry trade? Traders go either, well, let's use America only. I'm not going to use, because you could have done it in Japan or Europe. You borrow money at 0 or 1%. So you borrow money in dollars, you convert it to rands, and you buy our debt at 6 or 7%. Now that's all very well. The more money that came in, the stronger the rand got, and the lower interest rates came because it's demand. Now what happens is interest rates in the United States are starting to go up. The whole process reverses. People will start, traders now will be squeezed on the other side, have to repay their borrowings, are going to start selling the rand, selling our bonds, going back.
And the one thing that might have helped our rand was a rising interest rate environment domestically. But then yesterday, confound it, we get better than expected CPI, which takes pressure off Jill Marcus, and our trade deficit shrinks a bit. Suddenly, oh, hold on a second, we haven't got that little arrow in our quiver, Nick.
Yeah, and also what you also saw was, so this money came in, and people would have started off, as everyone does, very conservatively, and you would have hedged some of that currency exposure. So you would have said, fine, I'm just going to make the interest rate spread. And then the rand carried on getting stronger, and they sat there in London and New York and said, hang on, I'm missing out here. This rand's getting stronger. Right, the next tranche in, I'm actually not going to, I'm not going to hedge it, because the rand is just going to be stronger forever, and the US is doomed, and it's never going to grow again. And so now they've got these sort of more risky open positions. You tend to always forget the risk when you're getting that extra yield, and we always talk about that search for yield. And when it unwinds, it can unwind quite badly, as we've seen in African Bank share price. And there are a lot of retailers in this country that have massive foreign ownership.
But let's talk about African Bank, because that's such an interesting story. Yesterday, African Bank managed to raise 3-year money. The market believes that this is a business that will be around and flourishing sufficiently for the next 3 years, at least, in order to be able to pay back the money it's borrowing. That is possibly the most positive sign African Bank has seen in a long time, David.
It is positive. Look, it's a well-run operation. They're going through a bit of a tough time at the moment. No one believes they're going to fall over and die and collapse. It's just going to be tougher for them. That's all. And companies do go through periods like that. And I think we must accept it. Does it mean that you've got to go run buy the shares? No. Wait. That's what markets are. So I think it's a company that's certainly going to survive, and down the line will probably prosper. But we're going into a tough period in the SA economy, tough period for the consumer.
You're the kind of guy who likes to go in and buy mad things like Impala Platinum when nobody wants to go near it, Avenge in the construction sector when nobody wants to go anywhere near it. Why not African Bank?
It does certainly have a lot of
Impala and still
a lot of
he's going long.
we only just bought Impala recently, so we bought it 3 weeks ago. It's probably down 15-20% already.
Genius. Yes.
But the concern with African Bank is it's grown its loan book over the last 5-6 years from 5 billion to 50 billion, and no one really knows how well they've priced those loans. And those loans have been getting bigger, and they've been getting a longer time period. And that's very, very concerning. So, yes, the concern in the industry does pop up and give you some possible opportunities. But you can look at someone like JD Group, which has much shorter loans and much smaller amounts. So if they've got it wrong and the whole sector falls apart, and by the way, their pricing is still more attractive than African Bank, that would be a better entry point. But we also still are concerned, because that whole South African consumer story, I think there's a long way to play.
This is the first time I've ever heard anybody punt JD Group. JD Group over African Bank, David? You know the main protagonist?
No, you know what happened? I don't even want to look at JD Group from that side. What worries me on JD Group is more the cost with the rand at where we are now, well over 10. I mean, hitting close to 4-year lows or highs, whichever way you're going to read it. It's weak, the rand's weak, which means that imported equipment is going to cost a lot more. And I'm more worried about that side of JD than anything else. I think it's going to increase the costs of imported appliances, and I think that's going to start to weigh down, particularly in appliance
and
manufacturers.
That's a concern for a lot of the retail businesses. The difference with someone like JD is that the share price is significantly cheaper.
But here we're worried about the South African consumer. We're worried about the South African consumer's capacity to borrow, to spend, as has been happening for the last 10 years, growing to the crescendo that we've seen recently, and now the tapering off in that short-term borrowing. But people are still prepared to pay nearly $100 a share for famous brands.
Yeah, I'm one.
But this is now it's the same dynamics that are affecting South African consumer capacity to spend, or is it a different segment of the South African
I think it's a different segment. And I think it's a segment, and you know, you've got to do your own research. Go down to the malls in Sandton, go down to Sandton City, or into any of the new food areas. They're always packed, whether it's a Wimpy, whether it's a Steer, and various other ones. You go to a Tasha's, you can't get a table. And I think people are prepared to pay. That's their entertainment. They're prepared to take the family out for a Wimpy burger, etc. I'm not sure they're going in to buy another computer or another iPhone and so on. I think that's the balance. That's where the entertainment is, and I think and also there's been a change in our culture. We don't cook anymore. I don't think people cook anymore. They go out for takeaways, and that. So I reckon that famous. I don't know. It's not what you want to eat, but I mean That's where I think famous brands
enough people
well
do.
Placed. Yeah.
And Kevin Hedwick's argument is that, I mean, he's looked at global penetration of fast food and street food and the way different cultures live, especially when you've got two parents working and trying to hold down a household. They come in, they haven't got time to cook, so they've picked up takeaways on the way home. Our penetration rates of takeaways are very, very low relative to faster growing economies. And if we have a faster growing economy, that's the dynamic that pervades.
If we have a faster growing economy, but if we look at a lot of the other areas of the market, people are saying we aren't. So, you know, yes, that's true. If we have a faster growing economy and they carry on making acquisitions, etc., they can carry on growing like they have.
Is there anything left to buy?
I don't know. I mean, these Tasha's acquisitions, it's a lovely restaurant, but really,
you need
how much economies of scale, how much money do you really make? Who wants to own a restaurant? You know, I understand a chain like Wimpy that's a bit more scalable. The high-end Tasha's, I'm less convinced. But
David Shapiro likes to have breakfast a lot, and
I eat there a lot.
He does. Have you noticed?
I'm very upset with what
they've scaled back on the jams. No, you
and the chips as well.
You're getting an all-gold plastic tub of jam with a foil top. You used to get a glass bottle. They're now becoming more mug and bean than they are Tasha's. That's Kevin.
Yeah, it is Kevin, and that's where the money is going to be made. You know, to me, it combines manufacturing, logistics, and retail all in one. You know, they are making a massive amount on the manufacturing side. So the more outlets he's got, it's the franchisee's issue, not his.
He's roasting coffee. He's making long life milk and cheese at Kucha near
I saw the factory. I saw where they're going to build it there. I drove past it last week.
Impressive site?
No, they said this is where the factory is going to be.
Oh, so it's a bare piece of ground.
Kind of, yeah.
Oh, right. And increasingly going into that manufacturing space, they've done it very cleverly. Why would you still buy famous brands and not Taste Holdings? Because Taste Holdings is the wannabe.
I like Taste.
Is the wannabe famous brands.
No, I do like it, but it's smaller and it's not as liquid in terms of actually being able to buy a large holding. But I like Taste very much, and where I like Taste is at the low end of the market. Fish and chips. How much is a fish and chips in a piece of newspaper? Great TV ads
as well. Would you go for Taste over famous brands as a punt?
No, I think people are buying. They're taking this halo effect from famous brands and just applying the story as human beings love to do onto famous, onto Taste. So they may do it, but it's not massively compelling.
It's pizzas and fish and chips.
He says pizzas. He's stuck in the 70s. Right. One final one, and it's a little one. Have you had Copperberg cider?
I haven't.
This lovely pear cider. I'd rather still have a proper craft beer, but it's a Swedish-made cider, which you can get in places where they sell craft beer. And SAB has got this bizarre deal where it's got distribution rights on Copperberg cider. It's a drop in an SAB ocean. I can't believe they even bothered announcing it, but they did.
They're desperate. I mean, we've also, if you go to the States, and it's more so in Joburg recently as well, craft beer is a huge phenomenon. Obviously, SAB makes most of their money out of the low-end stuff, but they have been really trying to build their portfolio of higher-end beers. Plus, they've got this fantastic distribution network already, so it makes complete sense, just like we were talking about famous brands earlier. Just pop something more and plug it in.
Your margin goes from that on a Castle to that on a Pilsner or Quell. It is significant. So it costs you the same amount to make the and stuff. You just put another label on it and make it taste a little bit.
And they've been doing this for years and been very successful at doing it.
It's a fabulous